Imagine waking up to the exhilarating news that you now own a piece, however small, of OpenAI or SpaceX, two of the world's most sought-after private tech giants. You open your digital wallet, heart pounding, only to discover that your prize is not quite what you pictured. This was the surreal experience for thousands of European investors when Robinhood, the trailblazing trading app, launched a headline-grabbing giveaway of so-called stock tokens. The pitch was irresistible, a rare chance for ordinary people to get a taste of assets that had, until now, remained the playground of billionaires and insiders. The reality, however, was a dizzying blend of confusion, controversy, and a crash course in the wild world of tokenized investing. The projections for this market are nothing short of staggering. Boston Consulting Group forecasts that global asset tokenization could explode to nearly $19 trillion by the year 2033. Even McKinsey, usually the voice of caution, envisions a $2 trillion market by the year 2030. Deloitte estimates that tokenized real estate alone may approach $4 trillion by the year 2035. Meanwhile, Markets and Markets projects the tokenization sector itself to be worth over $13 billion by 2030, growing at a scorching annual rate of almost 20%. These are not just abstract numbers. They signal a tectonic shift in how value is owned, traded, and conceived. For everyday investors, the implications are revolutionary. True fractional ownership. No longer is it necessary to possess millions just to grab a stake in the next unicorn startup or a Manhattan skyscraper. In theory, you could purchase a sliver of OpenAI, SpaceX, or even a Picasso painting, all from the palm of your hand. This is the promise of a borderless, inclusive financial system. A universe where opportunity is not gated by geography or wealth. Robinhood, the disruptor that made commission-free trading the norm and welcomed millions of new investors to the world of stocks and crypto, spotted a fresh opportunity in Europe. In a splashy event in France, the company unveiled an entire suite of blockchain-powered products tailor-made for European investors. The centerpiece? Tokenized shares of private companies, specifically OpenAI and SpaceX, names that spark the imagination of tech fans everywhere. Robinhood, leveraging Arbitrum, a Layer 2 blockchain built on Ethereum, claimed to offer the masses a tantalizing taste of previously locked-away assets. At the event, Robinhood's CEO Vlad Tenev delivered a bold message. In his words, "While it is true that they aren't technically equity, the tokens effectively give retail investors exposure to these private assets." He framed the giveaway as merely the opening act in a much larger drama, hinting that many more private companies were eager to join what he called the tokenization revolution. But as is often the case in finance, innovation rarely arrives without a storm. Almost instantly, the backlash erupted. OpenAI, the artificial intelligence juggernaut, issued a clear and forceful statement. These OpenAI tokens are not, and never were, actual OpenAI equity. The company had zero involvement in Robinhood's product. Sam Altman's firm went further, warning that any transfer of its equity requires explicit company approval, which, in this case, had not been granted. Elon Musk, co-founder of OpenAI and now at the helm of SpaceX, was blunt, labeling the entire undertaking as fake. Now picture the average investor who, after securing what they believed was a precious token, learns that its supposed creators are publicly disowning it. The sense of disappointment is palpable, and so is the confusion. The Securities Industry and Financial Markets Association, representing a sprawling network of banks and financial institutions, urged the United States Securities and Exchange Commission to block digital asset companies from issuing such tokenized equities without rigorous oversight. Their stance was clear. The SEC should deny requests to make significant changes to the regulatory structure for securities markets. At the heart of the debate lies a fundamental question. Are these tokens a trailblazing leap forward, a true democratization of finance? Or are they a risky facsimile, an ornate mirage that leaves investors lost in legal gray zones, exposed to technical vulnerabilities, and vulnerable to fraud? The debate is intense and growing more complex by the day. Let's examine what the data tells us. According to a survey by State Street, a whopping 70% of institutional investors, think the world's largest banks, hedge funds, and asset managers, believe that tokenization could fundamentally reshape financial markets within the next 5 years. This is an extraordinary vote of confidence in the core idea, but enthusiasm alone does not erase risk. Rob Haddock, a general partner at Dragonfly, a prominent crypto investment firm, warns that the regulatory gray area could prompt private companies to halt share sales altogether. In his words, "The excitement is real, but so are the risks." Without clear legal frameworks, the very companies whose shares are being tokenized may pull back, slamming the brakes on innovation before it can truly accelerate. And the dangers are not hypothetical. Cybersecurity experts, such as those at Halborn, a firm specializing in blockchain security, have repeatedly identified vulnerabilities in the smart contracts underpinning tokenized assets. One high-profile hack could shatter trust in tokenization for years or even decades. The crypto world is littered with cautionary tales, from the infamous DAO hack that rocked Ethereum in 2016 to the spectacular collapses of exchanges like Mt. Gox and FTX. As the dust settles on Robinhood's European token experiment, investors are left grappling with unsettling questions. What exactly did they receive? Does a token that offers exposure to a company actually constitute ownership? Or does it more closely resemble a sophisticated derivative, a digital IOU whose value is tethered to the actions of multiple intermediaries and the unpredictable tides of regulation? Let's break down the distinction. In traditional finance, owning a share confers clear legal rights, a claim to profits, voting power, and sometimes a say in management. With these new tokens, the reality is far murkier. Many are structured less like true equity and more like contracts for difference or synthetic assets, digital instruments that track the company's price but grant none of the rights or protections attached to actual shares. This ambiguity has real-world consequences. Investors who believed they owned a piece of OpenAI or SpaceX may discover that their tokens are, in legal terms, little more than representations, backed by a third party's promise, not by the company itself. Should the issuer face financial trouble, or if regulators intervene, those tokens could evaporate in value overnight. The old investing maxim rings true: if you don't understand what you own, you don't truly own it. Yet the potential upside remains hard to ignore. If regulators and innovators can find a meeting point, if legal clarity and technological brilliance combine, the rewards could be monumental. Boston Consulting Group's nearly $19 trillion projection is not just hype. It suggests a future where assets of every kind are digitized, traded globally, and accessible to all. Retail investors could buy and sell fractions of companies, real estate, or art around the clock, while costs would tumble as smart contracts replace costly middlemen. The financial system itself could become more transparent, more efficient, and far more inclusive. Some of the world's financial titans are already moving. BlackRock, the globe's largest asset manager, is piloting tokenized funds. Fidelity, JP Morgan, and other heavyweights are quietly experimenting with bringing real-world assets onto blockchains. Industry observer Jim Wyant notes, "All the issuers are working on tokenized funds. This is a really active space right now." Kieran Fitzpatrick, who heads securities services at JP Morgan, foresees that, over the long term, tokenization will bring special advantages to exchange-traded funds, a market already worth trillions. Of course, optimism must be checked by realism. The road ahead is packed with obstacles. Regulatory uncertainty looms largest. Laws governing securities vary dramatically between countries, and most were written long before digital assets existed. The United States Securities and Exchange Commission is currently considering new rules, including the possibility of granting conditional exemptions for tokenized securities. Each policy announcement can trigger wild volatility in token markets, as investors scramble to anticipate what will be allowed and what will not. Security remains a constant concern. Blockchain assets are only as robust as their underlying code, and history shows that even thoroughly audited smart contracts can harbor critical flaws. Halborn's research underscores the stakes. A single exploit could result in losses of millions or even billions of dollars. For tokenization to achieve mainstream adoption, industry-standard security and frequent audits must become non-negotiable. Issuer alignment is another critical factor. A token's value ultimately depends on its connection to the real, underlying asset. If the issuing company does not recognize the token, or if disputes arise over its legitimacy, investors can be left holding digital shares that are worthless in the real world. This is precisely the predicament Robinhood's token holders faced when OpenAI and SpaceX publicly distanced themselves from the product, casting doubt over the token's legal and financial validity. Market fragmentation presents a further challenge. With dozens of platforms launching their own flavors of tokenized assets, liquidity can become scattered. Investors may find it difficult to buy or sell tokens at fair prices, especially when trading is limited to niche venues or hampered by cross-border restrictions. Achieving genuine democratization will require interoperability and standardization, ambitious goals that remain on the horizon. All of this leads to a pressing question for you, the everyday investor, the technology enthusiast, or the simply curious onlooker. How should you approach this brave new world of tokenized assets? First and foremost, adopt a healthy skepticism. Not all tokens are created equal. As Robinhood's CEO Vlad Tenev himself conceded, these tokens are not actual equity. They offer exposure, not ownership. Before purchasing any digital asset, ask tough questions. Does this token represent a legal claim? Is the issuer reputable and transparent? Have financial regulators weighed in? Is the company behind the underlying asset involved, or is this an unaffiliated third-party offering? Second, keep your eyes peeled for regulatory developments. Financial watchdogs around the globe are scrambling to catch up with the pace of innovation, and the rules can shift overnight. Early adopters who stay informed may spot unique opportunities, but must also be prepared for abrupt changes, from sudden bans to new taxes or shifting legal interpretations. Third, prioritize security and transparency. Only use platforms that are regulated, have a strong track record, and are fully transparent about how their tokens function. Look for regular, independent security audits, clear disclosures, and insurance against cyber attacks. Be wary of platforms that promise the moon but provide little in the way of safeguards. Fourth, diversify your risk. Never invest more than you can comfortably afford to lose. Tokenized assets, like all emerging technologies, can be highly volatile. Prices may swing wildly on rumors, regulatory actions, or technical glitches. Spreading your investments across multiple assets and platforms can help cushion the blow if one project falters. Fifth, understand the tax implications. Countries treat tokenized assets in dramatically different ways. In some jurisdictions, profits are taxed as capital gains. In others, as ordinary income. Failing to report your holdings correctly can result in fines or even legal trouble. When in doubt, always consult a tax professional before making substantial investments in this space. For those intrigued by the technology itself, delve deeper than the headlines. Blockchains like Ethereum, Arbitrum, and others are constantly evolving, with new protocols promising greater speed, lower fees, and enhanced privacy. But this rapid innovation brings complexity. Take time to understand how these networks function, how tokens are issued and redeemed, and what platform-specific risks may exist. It is also important to remember that not all attempts at tokenization have succeeded. Looking to history, the late 1990s saw the dot-com boom promise to transform finance through online stock trading. Many early ventures failed or collapsed in scandal, but the survivors, like E-Trade and Charles Schwab, paved the way for today's digital investment platforms. Tokenization may follow a similar arc: exuberant experimentation, followed by regulatory tightening, industry consolidation, and ultimately, adoption by mainstream institutions. Let's expand on this parallel. The dot-com era was marked by grand visions, platforms that promised to make investing as easy as sending an email. Most fizzled, some imploded spectacularly, but the lessons learned were invaluable. Today, online trading is routine, and digital-first brokerages dominate. Tokenization may be in its dot-com phase now, full of promise, dogged by uncertainty, but with the potential to reshape markets in ways we can barely imagine. Consider, too, the early days of exchange-traded funds, or ETFs. When ETFs first emerged in the early 1990s, skeptics doubted their utility, and regulators hesitated. Today, ETFs are a multi-trillion-dollar market and a staple of global investing. Tokenized assets may tread a similar path: uncertain beginnings, followed by explosive growth once trust, regulation, and infrastructure catch up. So, is the tokenization of stocks the inevitable future of investing, or just the latest high-risk experiment? The answer, perhaps maddeningly, is both. The potential is enormous. The vision of unlocking trillions of dollars in value, of making investing truly global and accessible, is compelling. Yet, the risks, regulatory confusion, technical vulnerabilities, disputes over issuer alignment, are just as real. Without clear laws, robust security, and genuine cooperation between asset issuers and token platforms, the hazards may outweigh the rewards. Here's a secret that few are talking about. Behind the scenes, the world's most powerful asset managers, names like BlackRock, Fidelity, and JP Morgan, are not merely spectators. They are actively building, testing, and preparing for a tokenized future. The real contest is not just between Robinhood and crypto upstarts, but between the established giants of finance and transformative new technologies. The winners will be those who master the delicate balance between innovation and regulation, who can scale trust as well as efficiency. Here's what you can do to stay ahead. Stay skeptical. Hype is everywhere, but thorough due diligence is rare. Don't let fear of missing out cloud your judgment. Question everything and demand transparency. Stay informed. Keep up to date with regulatory changes, read white papers, and seek out expert opinions. In this fast-evolving landscape, knowledge is your greatest defense. Stay diversified. Treat tokenized assets as just one slice of your investment portfolio, not the entirety. Balance is key to surviving market swings. Stay secure. Use platforms with proven security records, robust insurance policies, and transparent business models. Remember, a single hack can undo years of growth and confidence. Stay engaged, participate in discussions, ask questions, and challenge assumptions. The future of finance is being shaped by those who are curious and involved. Most importantly, stay tuned. The intersection of technology and finance is evolving at warp speed. Each new development, be it a regulatory breakthrough, a major cyber attack, or a blockbuster IPO going digital, could reshape the entire landscape overnight. Let's close with a question for you. Is tokenized equity a genuine revolution or a recipe for disaster? Will the dream of democratized investing become reality, or will regulatory uncertainty and technical risk keep these aspirations out of reach? Share your thoughts and questions in the comments below. And if you want more deep dives into the future of money, technology, and investing, be sure to like, subscribe, and ring the bell so you never miss an update.